Okay, so far we've been looking at how we account for accounts receivable under the allowance method. And there we were setting up those estimated uncollectibles and we wrote them off later when we figured out the customer. Now, using that allowance method is much more conservative. It's much better way of doing it, but there is a second way that you can write off uncollectibles. And this is called the direct method, as you can see here. So to be clear, the direct method, is not proper GAAP. So those allowances, that estimate of uncollectible amounts that we set up, we were doing that because we knew it was likely there were some amounts that we wouldn't get. And we know from that general principle of conservatism, if there's some sort of risk or uncertainty, we need to record it in the most cautious way. And doing that is setting up that estimate and that allowance. So the direct write-off method, because it's not proper GAAP, it is only acceptable in very limited situations. And if you use this method, there's actually no allowance account that is used. So we don't make an estimate. Instead, you just write off the specific accounts receivable for the customer when you finally determine the specific customer that it's going to be uncollectible for. So no estimates ahead of time, but the minute that you realize someone can't pay, that is when you do the write-off. So companies who would use something like this, rather than tracking and doing an estimate at the end of the month, instead, at the end of a period, they would actually look through all of their AR and at that point say, okay, what customers can't we collect from? If there's any, they would do the write-off. So looking for those write-offs is similar, but we just don't have an allowance now. Instead, we only take this one step and have this direct write-off. Okay, so the direct write-off method, we said it's not proper GAAP and it's inferior for two reasons. And those reasons are noted on the previous slide. So the first one is that it doesn't set up this allowance for doubtful accounts, which is the contra asset account. So because we're not setting up this estimate, AR, the net amount, since there's no net because we just have that gross amount, it would be overstated. So if it's likely that we're not going to collect some, but we don't set up this estimate, we have too much sitting in our AR because we're not deducting that allowance for doubtful accounts. Because of this, our AR is overstated. And then the second reason that it's inferior is that we're not matching the bad debt expense against the same revenue where it is earned. So when we use the allowance method and we're estimating that AR, typically we're looking at the period where that occurred because we do it at the end of every reporting period. So by estimating that amount, we're recording bad debt expense in the same period that we booked the revenue when we made the sales. So we're meeting that matching principle when we use the allowance method. For direct write-off, you probably won't figure out that you're not going to collect for someone within the same period, especially if you report monthly. So if you sell on account and you have AR, often they have at least 30 days to pay. So within the same month, if you don't have an estimate, you're not going to book the bad debt because you won't know until a future month whether this person can't pay or not. So we're not meeting the matching objective, and therefore it throws off our net income because the expense goes in a different period than the related revenue. Okay, so because of this, the direct write-off method is only acceptable in very limited situations, and this is when bad debts are very low. So if you don't think you're going to have much for bad debts or customers who can't pay, then having no allowance isn't as big of a deal because it's not a material dollar value. So if you really rarely have bad debts, it doesn't make that big of a difference if you haven't estimated them. So a couple examples of when a company may have very low bad debts. The first one is that they don't have very much accounts receivable at all. So a company who mostly has cash sales doesn't have a lot of accounts receivable and therefore very few bad debts. So retail stores would be typical of this, or a grocery store. Well, it's not like customers can go to Sport Chek and say, okay, I'd like to buy this winter jacket on account. No, you have to pay cash at that point, and therefore they don't have a lot of receivables, so wouldn't have much bad debts. And therefore they may use the direct write-off method. Another time when you would have low debts is if you only have very large and reputable customers. So if you're selling to customers who have been in operations and business for a very long time, they're strong companies, they have a really good reputation, chances are they're going to be able to repay you. So you will have bad debts not very often. So if that's the case, again, you don't expect to have bad debts, so your allowance is 0, and that's why you use this direct write-off method. And then finally, another time you could have low bad debts is if a company has a very strict credit policy. So you don't just give, or you don't just allow that many customers to buy on account. Instead, they have a bunch of credit processes that they need to go through, maybe submit financial statements, get a bank letter, things like that. So if you have these really strict policies, chances are whatever customers are able to buy on account, they're going to be able to repay as well. So a low amount of bad debts. And that's essentially what we're saying. When we look at these 3 situations, we don't expect to have bad debts, so there's no allowance to create because we estimate we won't have any. So we can't have that allowance set up and therefore use the direct write-off method. Okay, so an example of how this would be done. Here we say that we make another sale to Lloyd and Harry. So we give them another chance and we allow them, Muck Cuts, to buy on credit. But they've blown their suitcase full of cash before they can pay us back. So on March 6, 2020, we decide we will not collect the $2,000 that they owe us from this next sale. So we use the direct write-off method to clear it from AR. So we haven't got an allowance. Obviously, you wouldn't do this within the same company. I'm just following an example. But if you use the allowance method, you would always do it that way. If you only use the direct method, you would do it that way. So a company using direct write-off, they just debit bad debt expense at the time that they write this off. So instead of setting up a bad debt expense and allowance for doubtful accounts, now we just debit bad debt expense and credit AR for Muck Cuts. So you can see in the end, the step is the same. We've got a bad debt expense and we've gotten rid of the AR, but we missed that middle step where we set up the allowance. So note that the direct write-off method is not GAAP. So we are going to focus on using the allowance and doing it that way. So if you're asked, unless it specifies in the question that it's direct write-off, assume it's the allowance and use that AFTA and the entries that we saw previously.